Hey everyone, welcome back to Corporate Decoder. Today we're diving into a filing that's a bit like a financial magician pulling a rabbit out of a hat, except instead of a rabbit, it's stock, and instead of a hat, it's the stock market. We will be looking at Palmer Square Capital BDC Inc.'s recent filing about how they plan to sell a bunch of their stock, potentially changing their financial outlook and what it means for investors. This filing is a Form 8K, which is like a corporate breaking news report. Companies use it to announce big events that could matter to investors. In this case, Palmer Square Capital BDC is telling everyone that they've made an agreement to sell more of their stock. The key date here is March 3, 2025. This is when Palmer Square Capital BDC said they entered into a new agreement. It's important because it marks the official start of this new plan to sell shares. So who is Palmer Square Capital BDC? They're a business development company, or BDC. That basically means they invest in smaller and medium-sized companies, often providing them with loans. Think of them as a bank for companies that might not qualify for traditional loans. The heart of this filing is something called an equity distribution agreement. This is a deal between Palmer Square Capital BDC, an advisor called Palmer Square BDC Advisor LLC, and a sales agent, RBC Capital Markets LLC. It's all about selling up to $100 million worth of Palmer Square Capital BDC stock. Here's where it gets interesting. Palmer Square Capital BDC wants to sell up to $100 million of its stock. When a company issues more stock, it's like slicing a pizza into more pieces. Each piece or share becomes a smaller portion of the company. This stock sale isn't happening out of the blue. Palmer Square Capital BDC has already filed paperwork with the Securities and Exchange Commission (SEC) to register the stock. This registration statement, called a Form N-2, was declared effective in October of the previous year. This means the SEC gave them the thumbs up to offer these shares to the public. The sales agent, RBC Capital Markets, isn't obligated to sell a specific number of shares. They'll use their commercially reasonable efforts to sell the stock, but there's no guarantee they'll sell all $100 million worth. It depends on the market, the price of the stock, and other factors. Just as the sales agent isn't required to sell, Palmer Square Capital BDC isn't required to sell either. They can stop the offering at any time. This gives them flexibility to adjust their plans based on market conditions and their own financial needs. So what will Palmer Square Capital BDC do with the money they raise from selling stock? They plan to use it to invest in other companies, which is their main business. They might also use some of the money to pay down debt on their revolving credit facilities. RBC Capital Markets isn't working for free. They'll get a commission of up to 1% of the gross sales price for each share they sell. That may sound small, but it can add up quickly when you're talking about millions of dollars. And get this, the advisor, Palmer Square BDC Advisor LLC, might cover some of the costs. There's a catch to how low they can sell these shares. The price can't be lower than the company's net asset value, or NAV, per share. NAV is basically the value of a company's assets minus its liabilities, divided by the number of outstanding shares. However, they can go below NAV if they get approval from their shareholders. This is a way to prevent the company from selling stock at a price that would significantly hurt existing investors. Because RBC Capital Markets is helping Palmer Square Capital BDC sell the stock, they could be considered an underwriter under securities law. This means they could be held liable if there are problems with the offering. To protect themselves, RBC Capital Markets wants Palmer Square Capital BDC to agree to cover them for legal costs if things go south. Palmer Square Capital BDC is promising to protect RBC Capital Markets from certain legal liabilities. This is called indemnification. They're also agreeing to help cover costs if they both get sued. Dilution LLP, a law firm, has given their legal opinion that the stock Palmer Square Capital BDC is selling is, well, legal. It's like getting a thumbs up from the lawyers. Exhibit 104, that's the cover page interactive data file. Essentially, it's the digital version of the report that computers can read easily. Now, let's zoom out and think about the bigger picture. This move by Palmer Square Capital BDC to sell more stock has some pretty significant implications. On one hand, it gives them more money to invest, which could lead to higher profits down the road. They are going to use it to make investments in line with the company's goals. They might also use some of the money to pay back debts under their existing credit lines. On the other hand, selling more stock dilutes the value of existing shares. Imagine that pizza again, now each slice is smaller. That said, they can't sell these new shares for less than the net asset value per share. This means the company can't sell its stock at prices that significantly hurt existing investors unless they have a shareholder go-ahead. Also, remember that the sales agent isn't required to sell any specific amount of stock, and Palmer Square Capital BDC can stop the offering whenever they want. This adds a layer of uncertainty to the whole thing. So what's the takeaway? Palmer Square Capital BDC is making a move to raise capital by selling more stock. This could help them grow their business, but it also comes with risks for investors. Assessing Palmer Square Capital BDC's direction, there's both strength and vulnerability. The equity distribution agreement offers financial flexibility, enabling strategic investments and debt reduction. However, this move also brings the risk of diluting existing shares. The reliance on market conditions and the discretion of the sales agent introduces uncertainty. Overall, Palmer Square Capital BDC's decision reflects a calculated risk. While the potential for growth is apparent, investors should carefully consider the possible downsides. Thanks for watching. If you found this helpful, give us a like, drop a comment, and subscribe for more corporate deep dives.